Okay, we'll go ahead and get started. My name is Nick Strain. I'm a senior wealth advisor at Halbert Hargrove and also chair of our wealth advisory committee at Halbert Hargrove. And I have with us pleasure to introduce Guy Nicio at Wines Accounting and Tax Firm, also located out of Long Beach. Before I go ahead and introduce Guy, I wanted to do three housekeeping items. So during the presentation today, we're going to be talking about the new tax bill that was passed in July, and also year-end planning ideas. And Guy will be leading the presentation today. But the three housekeeping items are, if you have questions, please put them in. There's a Q&A button at the bottom part of the Zoom screen. So write your questions there at any point in the presentation, but we won't answer the questions until at the end. So that's not item number one. Item number two is please don't use the chat feature. We won't be using that today. And three, if you sign up for the webinar before this morning, you should have received the slides, Guy's slides. But if not, we'll be sending out a recording and the slides within 1 to 2 weeks of the presentation. So with that, we'll go ahead and get started. So we'll first on the wine side. So we have really a 30+ year relationship with wines, which is fantastic, and been working with them and partnering with them for many years now. And they're similar to us, Halbert Hargrove. They're nearly 100 years old in the public accounting sector. They have 30 partners, 250 professionals. You can see on the screen 4,000 businesses, and work with 39 individuals. So helping a lot of clients in both the businesses and high net worth space. And three main offices are in Long Beach, Irvine, and Los Angeles. And they have won many awards, as you can see, in terms of LA Business Journal, Best Places to Work, and Orange County Business Journal, along with more of the CPA or accounting top firms in accounting here. But importantly with Guy, so I've known Guy for now 12 to 15 years. We couldn't pinpoint the exact year, but I've known Guy for many years now, and it's been a pleasure and really great to see his success within wines. And he has over 25 years of public accounting experience. He's served as their tax partner in the tax department, and he's now the Long Beach office lead, along with serves on the board of directors, and he was a partner in charge of the tax department from 2020 to 2024. And he was named in the Los Angeles Business Journal as one of the region's top 100 accountants. And he has many other roles of kind of helping grow wines into the accounting firm they are today. So it's wonderful to see your success, Guy, and thank you for kind of giving us the presentation today to enlighten us on all the tax changes that have happened and how we can be more prepared. So with that, I'll turn it over to you, and thank you very much.
Thank you, Nick, for that warm introduction. Good morning, everyone, or good afternoon if you happen to be in a different time zone. Today, we're going to be talking about the One Big Beautiful Bill Act. It's got a few names that people like to refer to it because that's a mouthful. Some people call it OBBBA, some people OB3, some people just say the act. So we can use those interchangeably. But normally, when we have webinars on this topic, it's typically to professionals that are tax advisors. So I thought this group isn't really tax professionals, but clients who might want to take advantage of and be aware of the law changes with OBBBA and how that might impact them. So I'm going to speak with everyone today as if you were my cousin Shohei. No, he's not actually my cousin. Sorry, that was just a little fun since the Dodgers just won the World Series. I thought this group might appreciate that little fun slide. So the bill was signed into law on July 4th, 2025. And there's three big takeaways I'd like to cover. And one is that a lot of what is in the bill is making permanent what was in the Tax Cuts and Jobs Act back in 2017, effective for years beginning in 2018, and which many of were set to sunset at the end of 2025. It brings back favorable business investment provisions that were repealed by the Tax Cuts and Jobs Act. And then lastly, repeals energy credits and tax incentives from the recent Inflation Reduction Act. All right, so this first section, we're going to talk a lot about from the individual tax standpoint, what changes and what to keep in mind. I do want to say that this presentation, since it's going to be an estimated 30 to 40 minutes of content, and covering what could easily be anywhere from 2 to 4 hours of content if you were to go into every detail, like we commonly do when you're a tax professional and you need to know every specific detail. I think to keep in mind, the main takeaway that you might all want to think about, and if you take any notes, is these are just meant to inform you of broad categories, some general understanding about them, and maybe some things that you may need to follow up with your personal tax advisors to talk specifically about items that resonate with you for things that may line up with your own personal facts and circumstances. So again, the slides will not necessarily cover every detail because there are always nuances, criteria, certain things, and I'm going to try to include information for the major ones. All right, so one of the first things that we see is the brackets are made permanent that were changed in the Tax Cuts and Jobs Act. You can see here that the rates were ranging from 10% to the top tax bracket for personal income taxes at 37%. These 7 brackets are now made permanent, but they will adjust for inflation annually. This gives certainty from a planning perspective for all of you. Instead of wondering if there's going to be tax law changes that would increase or decrease, we now know that these rates are permanent. And so when you're working with your advisors or when you're doing your own calculations, you can prepare your year-over-year projections of what your income is and strategically align where you want the activity to land based on what tax bracket you might fall in year over year. So from a planning perspective, you can look as much as 3 to 5 years. Consider accelerating income into years where you expect to be in lower brackets, or deferring income if you anticipate lower future rates. There's a brief example here that I won't go in detail. You can read that at your pleasure, since everyone does have a copy of these slides. Of course, if you don't happen to, for some reason, if you didn't, you can always reach out to the friends of ours at Halbert Hargrove to request a copy of that slide. Next is the standard deduction and personal exemptions. Those were slightly increased before under TCJA. They show what they were. And now after OBBBA, there's a higher standard deduction made permanent. And for 2025, the amounts are shown here: $15,750 for married filing separately or single, head of household slightly higher at a little over $23,000, and then of course married filing joint being the highest at $31,500. Personal exemptions are eliminated. So those were originally eliminated in the TCJA, and now they are permanently eliminated. And by the way, permanently means until and unless there's future tax legislation. It just means there's no automatic timeline for them to sunset, as we call it in the industry, on a specific date. So fewer taxpayers will benefit from itemizing unless there are large deductions, like high net worth individuals will need to work harder to generate deductible expenses as a result of this. So from a planning perspective, assess where itemizing is still beneficial for you. Large mortgage interest, charitable contributions, SALT planning, and I'm not going to go into detail on this slide because there are subsequent slides where we'll talk a little bit more about each of these items. Same with the next bullet point here. Consider bunching deductions, charitable and medical, to exceed the standard deductions in high income years, but also there are more details to be shared in later slides, specifically on those 2 items. All right, so the SALT deduction, which stands for state and local taxes. I'm sure that most of you have heard tidbits about this, but if you're wondering exactly what it means, for those itemizers who are able to deduct their deductions greater than the standard deduction, a piece of those itemized deductions is the state and local taxes on Schedule A. And the TCJA had the maximum amount that you could deduct as $10,000, which was a very low number. And for those of us who are in high income tax states like California, we basically did not get the benefit, absent a couple other planning opportunities, of most of the state income taxes that we paid for both income as well as property taxes, because it's all part of the same bucket. But after OBBBA, for tax years 25 through 29, that cap has increased to up to $40,000. So it's 4 times for certain taxpayers, with phased down, and this is going to be a common theme in this presentation, is that almost every tax incentive will have AGI limits, where the benefits that are offered under this act will be decreased ultimately in many cases to zero once your income is over certain thresholds. So in this case, those thresholds are between 500 and 600,000 AGI at the married filing joint filing status, where you would revert back down to 10,000. So it slowly will lose the cap of 40,000 as your income increases for over 500,000 until you get to 600,000, in which case your cap will be 10,000, and it will never be lower than that. The implications is residents of high tax states, as I mentioned, like in California, but also New York, New Jersey, also other high income tax states can benefit more in the near term, but planning over the horizon, because in 2030, it reverts back to $10,000. A few planning pointers here: consider accelerating state and local tax payments. State residency planning, that's probably a little bit more advanced than we need to go into for this presentation. And then there's another example here that I won't go through together with you, but that you can review on your own time. All right, so here's a big one that kind of works together with the SALT deduction. And maybe many of you have heard of this already. Some of you may not, but it's for those of you who have an equity ownership interest in a pass-through entity, such as an LLC, a partnership, or an S corporation. This allows you to make an optional election to pay basically California tax for the income, the California taxable income that is generated from that pass-through entity. And it's only on certain qualified income. And the tax that you pay is a fixed amount of 9.3% with this election, even though you might be in the higher tax bracket up to 13.3% in California, which is the max. But what the benefits of the PTET election are, is that you get a 100% federal deduction for that state tax that is paid. In other words, it directly reduces the taxable income on your federal K-1. And do not have to be subject to the $10,000 or $40,000 SALT cap limitations discussed on the prior slide. Instead, you will get the benefit of 100% deduction for from your federal taxable income for all of the California PTET tax paid by making this election. Please remember that this election is due by June 15th every year. This particular year, however, we had LA County Fire Relief, where all of our deadlines for both payments and filing tax returns that were due after January of the enactment date of this particular law, 2025, where it's deferred until October 15th. So you may have not made this election this year by June 15th. You had until October 15th if you were an LA County resident, taxpayer, or business. The unpaid, and just to briefly go over the requirements for the June 15th election, it's the greater of $1,000 if you had no prior year tax, or 50% of the prior year pass-through entity tax. The unpaid, or the balance, is due with the due date of the tax return, or if you want to current your deduction by December 31st. So one planning tip, which is a big one, and some of these things are not necessarily new under OBBBA, but still very important to remind everyone. A lot of people have single member LLCs. In other words, you may be the only owner of an LLC. A lot of real estate entities are commonly like small businesses that there's only one owner. Well, you cannot take the pass-through entity tax election if you are a single member LLC, because it's a disregarded entity for federal tax purposes, and it does not file a federal tax return, so it's really not considered a pass-through entity. So if you were to add a second partner, for example, a minority interest, 1% interest, or even a spouse to be 50-50 owners in your single member LLC, that will convert it to a dual member, fully filing federal return in which you can make the pass-through entity tax election. Another planning tip is to analyze wages versus K-1 income for S corporations. This pass-through entity tax, again, is only on business income for California, that's on California K-1, but not for wages. For S corporation shareholders, you may or may not know, you're required, if you're actively involved in your business, to pay yourself a reasonable wage. But there is some subjectivity in that. And in general, it's to your advantage to minimize the amount of wages that you pay to yourselves on a W-2 for purposes of taking advantage of, one, the pass-through entity tax election, where you can deduct your state tax paid. You cannot do that for wages. And two, we haven't talked about yet, 199 Cap A, the 20% deduction, which we'll go into on a subsequent slide. All right. Next up, we have the charitable contribution deduction. New under OBBBA, for non-itemizers, you can claim a charitable contribution deduction of up to $1,000. Even if you do not itemize, previously you would have had to itemize. The deduction is available beginning in 2026. TCJA increased the limitation for cash charitable contributions from 50% to 60% of your AGI. That has been made permanent with this new act. And also brand new and not necessarily favorable, but something we all need to consider for planning purposes is there's now a 0.5% AGI floor for charitable contributions beginning in 2026. And what this means is similar to medical deductions, which are subject to a 7.5% floor on your itemized deductions, you do not get to take the deduction for the first 0.5% of your AGI amount of your contributions. I know I didn't probably say that the best way to understand, but there's a little example here that says in 2025, if John's AGI is $500,000 and he donates $5,000 to charities, his tax deduction would be limited to $2,500 instead of the $5,000 he actually donated. And that is because the first 0.5% of the AGI, so 500,000 times 0.5%, is not deductible. And so you subtract that amount from the amount you actually donated, and that's how we arrive at the $2,500 donation. So from a planning perspective, you might want to increase or accelerate charitable donations to 25 versus 2026 in a bunching strategy where you group all of your donations into one year and maybe not the next, so that you're over the floor and everything in excess of that becomes deductible, rather than having that limitation in 2 consecutive years. Also, there's a strategy around this where taxpayers who are aged over 70 and a half can make qualified charitable distributions directly from an IRA account known as QCDs, which are not subject to the 0.5% floor. And also you may consider using a donor advised fund where you can make, without having to decide what charity you want to go to at the time, whatever amount that you feel so inclined to donate to charity, and you get a deduction in the year which you made that donation to the donor advised fund. All right, a few other miscellaneous other changes that I wanted to include just for your reference, but didn't necessarily want to go through in detail. The home mortgage interest deduction, which caps the deduction to the amounts associated with up to $750,000 of debt, that's been made permanent, but also added our mortgage insurance premiums are deductible beginning in 2026. Educator expenses in excess of the above the line deduction are now non-2% miscellaneous itemized deductions. So if any of you are teachers or have spouses perhaps, or loved ones that are teachers, you can let them know that they can take deductions for their educator expenses without having to worry about the fact that 2% miscellaneous itemized deductions are no longer available. But now, since they are not in that category, they can be deducted if you're itemizing. Gambling losses, just a quick tidbit. There's a new 90% limitation on losses beginning in 2026. Itemized deduction phase outs have been reinstated. So there is a limitation again for high income earners now that will limit the amount of itemized deductions. And then lastly on this slide, disaster relief provisions. Since this is Los Angeles County, at least where I'm sitting, the Los Angeles wildfires qualify for the enhanced disaster relief provisions. And here's some bullets which explain briefly what those benefits are. The 10% floor on net casualty losses is not applicable. $100 limit is increased to $500. And taxpayers can claim the personal casualty loss even if they don't itemize. All right, so briefly on this slide, won't spend too much time on this, but here are some increases in the child tax credit and other family work provisions where that child tax credit has been increased from $2,000 to $2,500 per qualifying child. Other provisions are the deduction of certain overtime and tips, which we'll have some more detailed information on later slides. The implication is that high net worth individuals, large family deductions matter for planning. These credits may support shifting income to children or structuring family businesses compensation. So if family businesses pay children legitimately for work, ensure compliance with age role and W-2 wages to shift income. Review tax advantage savings for children. Consider recharacterizing compensation to next generation when beneficial. And then again, here's another example of where you can take advantage of this. Very commonly used for business owners who have family businesses. Again, keywords are legitimate for work. We don't want to make this up. we do want to ensure that we are actually paying our children if they're in our businesses and they're actually doing the job. So you don't want to pay someone who's 6 months old to be your controller, for example. All right, next slide. No, here's a little more detail on the no tax on tips, overtime, and auto loan interest. These are interesting items under OBBBA. There's no tax on tips. Certain tip income is non-taxable, subject to certain rules, effective for the years 2025 through 2028. And this, like many things, phases out when your AGI is above certain levels. I don't show the floors here, meaning where it begins to phase out, but just know that it'll slowly phase out your benefits on this deductibility, and it completely phases out once your AGI is at 400,000 for single filers or at 550,000 for married filing joint. Similarly, there's a deduction for overtime pay for 2025 through 2028, up to 12,500 for single filers, 25,000 for married filing joint. It phases out completely at a lower level of AGI when you're $275,000 for single filers or 550 for joint. And there is some guidance, by the way, that is expected to come out on this and many other provisions because there are details that aren't necessarily known. For example, how are we going to know what overtime qualifies for this? Our employers are going to be required to disclose in separate boxes the amount of overtime that qualifies for this deduction. Well, stay tuned. That guidance is not yet out. Next up, something new, and that in my time as a tax professional, we've never had the opportunity to take advantage of, and that is we get a deduction for interest on auto loans for U.S. assembled cars. There's obviously some rules and some criteria that has to be met. This is for the tax years 2025 through 2028. It's capped at $10,000 per year, and it phases out completely at these lower levels. So when your AGI is $150,000 for a single filer or $250,000 for a joint. So the implications are, while originally aimed at wage earners, business owners with compensation from family businesses, especially those with service incomes, may leverage these. So planning-wise, structure family business to the point where children and spouses legitimately earn tips or overtime might yield tax benefit since they'd have income AGI thresholds where they could take advantage of these deductions. Evaluate auto purchase timing if interest deduction will apply for U.S. assembled vehicle. Or also, maybe if you have an adult child, rather than buying them the automobile on loan yourself where you can't deduct if your AGI is above the threshold, perhaps you might gift them the money and they could buy it themselves and take advantage of deducting the interest on the loans since their income may be lower than yours. All right, another thing in OBBBA, and this is not applicable to everybody, but when it is applicable, it's a huge, huge tax savings opportunity, and that is qualified small business stock under IRC section 1202. It's prior to OBBBA, taxpayers could exclude up to 100% of QSBS gain after 9/27/2010, up to the greater of $10 million or 10 times the tax basis of the C corporation. If you meet these requirements, stock was held for at least 5 years, C corporation has gross assets of 50 million or less before and after the stock issuance, and the corporation's assets are used in an active trade or business other than certain excluded businesses such as professional service firms, accounting, law, medicine, banking, etc. The thing to remember here that I want to point out is that if you are an owner of a corporation, that this only applies to original C Corp issued stock. And I've got this in a point down at the bottom under the planning tip, but if you're considering for other reasons, tax motivation reasons, to convert to an S corporation, then even though that may be tax advantageous in the short term, if you have plans to potentially sell a highly appreciated corporation, you would permanently lose this benefit or this opportunity to save under the section 1202 provision if you convert to an S corp, because now it's no longer original C corp stock. So under OBBBA, this partial exclusion can be held for less than 5 years at lower exclusion amounts. So it's 50% if held for 3 years, 75% if 4, and of course back up to the 100% if it's 5 years or more. It increases the gain cap from a $10 million exclusion to $15 million, and the asset test is increased from $50 million to $75 million. So again, not for everybody, but if it applies to you, absolutely an extremely worthwhile provision to take advantage of. All right, next up, and this is a popular one, the estate, gift, and trust tax changes. Many in the industry and many high net worth individuals like you or your clients have had this on their radar, wondering what was going to happen with the estate tax lifetime exemption. Under TCJA, the federal gift estate tax exemption was, back in 2022 anyway, 12.06 million. It was increased for inflation, so it was roughly 13 point something million, I think, most recently. Scheduled to revert back to $5 million, a huge decline at the end of this year, 2025. However, under OBBBA, and this is a great outcome for high net worth individuals and families to do wealth succession planning, the exemption is made permanent at $15 million per spouse in tax years beginning after December 31st, 2025. So this provides certainty for high net worth individuals from a planning perspective, helps you to execute gifting strategies, to know what's imminent and what's not. And many of you may think that, that number's too high for me or too high for my client. Don't need to worry about it. I'll talk a little bit later about briefly portability, so keep that in the back of your mind. But just to continue on the slide here, changes to trusts and endowments, for example, taxes on endowment income of large cause and university increased. This also applies to generation skipping transfer tax exemption. So the implications here, estate planning can proceed with greater confidence in high exemption levels, but high valuation trust and structures will still need review. So if you're expecting large estate transfers, consider using lifetime gifting now while the exemption remains high. Because even though this is said that it's made permanent, remember, permanent really means until and unless there's additional tax legislation. So a future tax administration, presidential administration may decide to pass tax law that contradicts this change and reverse it to some other lower number. So while this is available to us under these large numbers, it is valuable to execute gifting strategies. And for those of you who don't know, the tax on any estates that are subject to the estate tax is huge. It's 40%. And so if you are ever subject, so the goal is to minimize any estate amounts that would be subject to a 40% tax. You'd rather have your assets go to your heirs rather than to the federal government in most cases. So reevaluate trust funding strategies. Portability elections, I mentioned a moment ago. Portability elections on first to die, these could be extremely valuable. So a lot of times you may not have a requirement to file a 706 estate tax return because your estate is too small when the first spouse dies. But if they have an unused estate tax exemption, you can preserve that as the surviving spouse by filing a 706, making the election, and then it gets added to your own unused exemption, potentially doubling what you have for future. So if the value of your estate increases, if you have many years to go, who knows what happens in the future, you can escape some of the estate taxes if the exclusion either reduces in the future by new legislation, or if your net worth just grows. And the good news is you have 5 years from the date of death of the first spouse to file the 706 and make this election. All right, I will leave the observation to you to keep moving along here and keep us on time. But next up, just a quick mention. You may have heard that there are these new Trump accounts available under OBBBA. They're retirement plan like tax advantage savings accounts. They're not large amounts necessarily, but if they apply to beneficiaries under the under the age of 18, Roth IRAs are not eligible, and there's certain own investments that are allowable. There's guidance awaiting on this. You must have a Social Security number. And also some changes to 529 plans. Taxpayers can make after-tax contributions to the accounts. Earnings are tax-free if withdrawn to pay for qualified higher education expenses as defined, and that definition has expanded pretty robustly. Here's another one that some of you may have heard of. This originally came back in about 10 years ago. I don't have the year in front of me, but opportunity zones have been a very robust tax savings vehicle for those who have capital gain and had wanted to defer some of that gain and receive some of the other benefits. Under the old law, you could defer that gain until December 31st, 2026. You would get a step up in basis at the 5-year and 7-year mark if you continue to hold that investment for that long. And then the big one, and this is huge, not everybody understands this, but you get to make an election to permanently exclude all the post-acquisition gains in an opportunity zone fund if you hold the investment for at least 10 years. And so what that basically means is if you invest in an opportunity zone fund because you had capital gain that you wanted to defer, you would not only get a step up in basis of 10% and 5%, so a total of 15% permanently excluded if you held that investment for 7 years, but at the 10-year mark, if you continue to hold that investment, any appreciation after the point of the investment is excluded from federal income until you sell it. And I think the cap here you'll see later is 30 years under OBBBA. It's a huge, huge opportunity to save. So that election has been made permanent. The deferral is the earlier of 1, the investment sold or exchanged, or 2, 5 years. You now get a partial step up in basis of 10% after 5 years. And then again, the election to exclude post-acquisition gain for property held at least 10 years remains. And it's capped at 30 years. So for the first 30 years that you hold your investment in an opportunity zone fund, all of that appreciation will be tax-free for federal purposes in opportunity zone funds. All right, that was a mouthful. But moving on to the next slide, retirement savings and high net worth planning considerations. Again, this is kind of a recap of some Trump accounts. We talked about that on the prior slide. High net worth individuals should factor business owner retirement planning, 401k, defined benefit pension plans into personal tax strategy based on these new deductions, based on the phase out limitations. The implications are to integrate business tax benefits. We haven't talked a whole lot about that, but that will be coming up in the next section with personal retirement planning. And then just a few points about accelerating business deductions under Section 179 and bonus depreciation. We haven't gone over those slides yet. And a few things like Roth conversions. And then there's another example of where they can benefit from some of these deductions. All right, so more on the summarization slide here, evaluate income timing, retirement contributions, and Roth conversion opportunities, itemized versus standard deduction decisions, bunching deductions, charitable giving, SALT planning, gift estate planning early while high exemption levels remain. Again, leverage new provisions for qualified business income. We haven't talked about that yet, but that'll be coming up on a slide shortly here. And then coordinate the business tax savings with personal tax optimization. All right, so here's some case studies that I'll skip over for now, since we haven't really talked about the business owners QBI deduction and 199A, but we'll talk about that later. And this slide is here for your reading pleasure at your leisure. So what are the next steps from an individual standpoint? Prepare an updated personal tax projection for 25 through 2027 under the new law. Substantial changes. Review itemized deductions versus standard. Again, bunching and charitable strategies. Review business interest and pass-through income, QBI eligibility, SALT exposure, estate and gift planning, and again, integrating this with your business strategies. All right, so now, my friend Freddie, well, this is just, another opportunity to put a Dodger slide in there. I don't actually have a friend named Freddie, but as you know, this is Freddie from our world champion Dodgers, and they just want to break up the dry topic of tax law under OBBBA by hopefully bringing a smile to your face, thinking about your world championship Dodgers. All right, so now on to the OBBBA and the business section. There's a quick agenda on some of the things we're going to cover, an overview of the major changes, restoration of and the permanency of the 100% bonus depreciation for qualified assets beginning January 2025 for many businesses. It had scaled back down to 60% under TCJA, and so now it's back up to 100%. There's an expansion of qualified property for purposes of bonus depreciation, manufacturing buildings, under certain conditions. There's changes to the interest deduction limitations and R&D expensing, and then again, 199 Cap A for pass-through entities, which we'll go through in more detail later. All right, so here are the rules. Bonus depreciation allowed 100% for qualified property. Again, I talked about that it was phasing out before, but after bonus, it's now back up to 100%. So you get the immediate write-off of the full cost of qualified property rather than depreciating over multiple years. So that can be huge. In many cases, the years are 5, 7, or even 15 years for the normal depreciation lives. So consider accelerating some of these purchases on qualified assets for equipment and certain real property into 2025. So you have just under a couple months left to do that for you business owners. Section 179, another depreciation provision, previously had a $1 million deduction cap with a phase out of $2.5 million for 2023. Under OBBBA, that has been expanded and increased to $2.5 million from $1 million with a phase out beginning at $4 million. So if you have considered purchasing assets, developing property of eligible property, you will have the opportunity to take immediate deductions against current income rather than depreciating it over the long lives normally associated with this type of property. All right, planning, manufacture, and production businesses should evaluate whether the new real property investments qualify, the timing of any construction versus the placed in service dates, and compare Section 179 versus bonus depreciation. Here's another example that I will let you read at your leisure, so we can move on to pass-through entities and the QBI deduction. So under TCJA, owners of pass-through entities, S corps, partnerships, and sole proprietorships could claim, I think that might be a typo, sole proprietorships do not qualify as a pass-through entity. So S corporations, partnerships, and LLCs could claim a 20% deduction of qualified business income under 199 Cap A, subject to phase-outs, wage and asset tests, and service business exclusions. Under OBBBA, the 20% deduction is made permanent. It was previously set to sunset at the end of 2025. So this permanency does allow us more opportunity to take advantage of what has been a fairly robust tax savings opportunity. So we now have stability in planning. Decisions can be made on the proper structure to take advantage of this, an LLC versus an S corporation. The increase in the phase-out ranges beginning 2026 are increased from 50,000 to 100,000 and 75 to 150. Those are the ranges, but the actual thresholds are shown in this chart below. 394 to 494 for merit filing jointly, and all other taxpayers 197 fully phased out at 247. So the planning opportunities here are to review whether the business meets the wage and asset test to avoid phase out and consider modifying compensation. Again, just to remind you, this webinar is intended to give you things to talk further about in more detail with your personal tax advisors. You're not expected to understand or remember every single detail or know every requirement about all of these provisions, but just to know that if you are someone that fits into this category, that there might be an opportunity for you to save if you talk about this with your advisors. So evaluate your income timing. If the income spikes, consider shifting income and losses into alternate years or use retirement contributions to reduce taxable income. I'll move forward with this observation. Talk next about the interest expense deductibility and loss limitation. This is an improvement over the prior law under TCJA. Previously, business owners were limited to 30% of adjusted taxable income, and adjusted taxable income was reduced, or it included the reduction for items of depreciation, such as bonus. Now, under OBBBA, you do not have to reduce your adjusted taxable income for items of depreciation, amortization, or depletion. You have to exclude those, so it'll make your ATI higher. Therefore, your limitation on your interest expense paid is not going to be as low. In other words, more interest paid will be deductible for tax purposes under these new provisions. All right, moving right on here. Another state and local tax and business nexus consideration. Just a reminder to factor this in with the PTET election as well, and optimize between the increasing cap and the PTET election for businesses that pass through entities. All right, I mentioned in the beginning that there was the rollback, a repeal of many of the incentives for clean energy and investment credits. We didn't talk about that on the personal section, but just a quick tidbit on that is that solar credits, for example, will be expiring at the end of this year. They do have to be placed in service and already in place. You can't just pay for it. So if you still have an opportunity to implement solar energy in your homes, for example, or any components of it that would qualify, you have until the end of 2025 to do that and take advantage of that 30% tax credit. But this slide is talking about on the business side, OBBBA phases out or eliminates certain clean energy tax credits and modifies credits for production and manufacturing certain property. The implications are business planning and renewable energy efficient commercial building projects need to be reassessed and expect credits flow and timing now while you still have time. Many assets must begin construction by June 30, 2026 to lock in these benefits. Evaluate alternative investments if credits will disappear or are limited. And then here's an example where it might apply to a real estate developer considering solar installation. All right, next we talk about research expenditures. And this is a big one, especially for those in the tax professional community. We're working on clients that have qualifying research and development expenditures. Most recently, there have been some very unfavorable changes where you were required to capitalize the costs of research and experimental expenditures and amortize those over a 5-year period. So for those people who are taking research and development tax credits that have been very robust and very favorable, that requirement to capitalize and amortize that over a 5-year period caused a cash flow issue, since you had to add back the expense the more that you identified as research expenditures. But now, we see new IRC Section 174 election amortized, election made finally return, election is made for all subsequent queries. I think this is nope, let me go back a slide. Well, let me just say that the change in the research credits is that you no longer have to amortize those over 5 years. You do get to expense those immediately, and there is an opportunity to go back and amend and claim the remaining deductions that you didn't take under the old rule. So very favorable. If you do qualify and have research expenditures, please do talk with your personal tax advisors or your business tax advisors so that you can take advantage of these and perhaps amend some prior returns to deduct expenses that you were previously amortizing over that 5-year period. Next up here, and we're getting close to the end of our time here, employee retention credits. Many of you may know that. The only reason why I'm including this here is because the IRS is no longer going to be processing refunds after July 4th, 2025 for claims filed after January 31st, 2024 that are related to wages paid after June 30th. So basically what this means is if you had qualifying wages in the 3rd or 4th quarter of 2021 and you filed a claim under the employee retention credits after January 31st, 2024, well, if you haven't received, if that refund hasn't been processed already, it is no longer going to be processed, and you are not going to get the ERC claim refund. And the bad news is that you may have already had your tax preparer file your returns based on the add back that's required under employee retention credits and picked up the income on your personal returns. And now these are going to be disallowed. So you would have to amend those returns in order to claim the deductions that you previously did not take because of the ERC claim. And they did extend the statute of limitations to amend those returns originally to 5 years, and now to 6 years you have to amend those returns so that you can make sure you did not get whipsawed and miss out on your opportunity to claim wage deductions where you didn't even get the benefit of an employee retention credit refund. All right. So some timing and transition rules for business owners. Some provisions of OBBBA apply immediately for 2025 tax year. Others have delayed or phased effective dates beginning in 2026. So here are some implications that are the strategic timing is critical. Year-end decisions are important of when you make asset purchases, entity elections, compensation changes. They may yield different outcomes. So prepare a tax calendar for your business, the key dates for acquisitions and elections. And then here's an example of that. Again, a recap of some of these business owner planning opportunities. Accelerate capital expenditures to benefit 100% bonus depreciation and enhance Section 179 provisions. Review and optimize entity structure and compensation strategies to maximize QBI deduction. Model debt versus equity for financing to maximize interest deduction under the new laws. Reassess renewable energy credits and project timelines given sunset or phase outs of these credits. And make sure you coordinate both the business and the personal tax outcomes, considering things like the SALT cap limitation, the pass-through entity income tax election, and state nexus. Conduct what-if modeling to determine the impact of changes on taxable income, cash flow, and after-tax profit. I won't go through this business owner example case study, but is there in the slides. Some next steps. You can read these on your own, but here they are for you to keep and execute at your leisure for reading purposes. Again, make sure that you are mindful of the interactions between business owners and high net worth. So a slide that kind of talks about that a little bit. And then key takeaways. The OBBBA, again, makes permanent many business and individual tax benefits previously scheduled to expire at the end of this year no longer will expire. Business owners face significant planning opportunities. High net worth individuals must coordinate these tax law changes with their personal income tax, state, and local considerations, as well as state gift planning and retirement strategies. Timing is crucial. 2025 is a pivot year, and a proactive planning mindset rather than a wait and see offers the greatest tax savings alignment of wealth strategies. So with that, I give you your world champions, Dodgers. Final slide. I promise not to give you any more of these Dodger slides, but hopefully you enjoyed those. And that is the presentation. So we will open it up for questions with Nick. All right.
All right, Guy, thank you so much. Appreciate all the great information you provided. For participants, the Q&A buttons on the kind of bottom middle part of the screen. If you just put your cursor at the bottom of the Zoom screen, you should see the options there. Under resource or next to resources Q&A. So
I'm looking at the questions, Nick, and I don't see any now. So that either means one, I did a superb job of answering everything anybody could possibly think of, or two, people are sleeping and out doing better things. Hopefully not the latter, but I will say that if no questions come in and anybody does have a follow-up question, I think you can feel free to email your contact at Halbert Hargrove. They can forward it to me. I'd be happy to email you a response, or you can, of course, talk with their personal tax advisors.
Okay, so we have a question. So it says widow taxes versus Roth conversions.
I might have to get back to you on that one. I'm not sure I'm familiar with widow taxes, and but Roth conversions are definitely a strategy that you have to evaluate. You know what a Roth conversion is. It makes your retirement plan, your individual retirement plan account taxable, where it was previously not taxable. So you have to weigh the benefits between the cost versus the benefit of paying immediate tax versus what the future appreciation would be that would not be subject to tax in the future. So Roth conversions are not taxable for all of the gains. It means you paid with after-tax money. So if you convert, the challenge is the cost, the tax that you're going to incur, going to be worth the savings that you will benefit from? And a lot of that will have to do with the amount of time that you have expected in your life for the period of time you might own the Roth before you distribute it, and how much you expect that to appreciate. I'm sure that your wealth advisors at Halbert Hargrove do a great job of modeling some of those retirement outlooks, and they might be able to help there. But we can send a follow-up email to you with more information on the comparison to widow taxes. So thanks for the question.
Okay, next question. RMS post-spouse passing on taxable investments versus saving on paying now. I think you're touching on all of these factors.
I'm not sure what the question is there, but if
RMD, sorry. She meant he or she meant RMD, not RMS. RMD, post-spouse passing.
Right. So there is no RMD requirement for Roth because it's already after-tax money, but there is an RMD requirement for IRAs or other retirement accounts. So you have to factor that in where the required minimum distributions would be taxable, and depending on your income bracket, you may have to plan for what the benefit is there. And again, going back to RMDs and the charitable contribution strategies, for those of you who do have charitable intent, you can make those to CDs to directly donate to charities without the limitations of the AGI floors and still fulfill your RMD requirements.
Yeah, and if you are subject to required minimum distributions, definitely please reach out to your Halbert Hargrove wealth advisor to talk about the options if you want to have contributions go directly to charities. That is something we do think is beneficial. Any other questions that we can help answer? Oh, we have one. Okay, I was planning to replenish a donor advised fund in 2027. Should I plan to make the donation this year so that the first 0.5% isn't disqualified like it would be in 2027?
Well, the answer to that is you can certainly do that, but it's really difficult to say that yes or no without knowing your overall tax situation. So it is important to look and work on these calculations and doing a multi-year strategy where you look at what your income is year over year, because I don't think it's a one-size-fits-all answer. It's conceptually, I think you're right on point, trying to work around that floor and take advantage of the fact that you don't have a limitation, but I do think it's still important to look at the picture as a whole to make sure that you're optimally planning for all of your income and expense activities for a multi-year period. But bunching strategies, including donor advised funds, are one of the things I talked about earlier, and definitely are an effective way of mitigating the implications of these new rules under the OBBBA.
Okay, thank you, Guy. Please feel free to type any questions in. Okay, so as I stated at the beginning of the presentation, we will send out the recording within 1 or 2 weeks. And then also, if you have additional tax questions, feel free to reach out to Guy, or you can reach out to the Halbert Hargrove team to ask your questions, and we can get in touch with you, and then either loop in Guy or loop in your CPA that you work with. So we really appreciate everybody attending and the questions you provided. And Guy, thank you so much for presenting today. We appreciate your insights into OBBBA and how to be proactive in tax planning. So thank you.
It is my pleasure, and thank you everyone for your time and attendance today, and to Halbert Hargrove for allowing me to speak with all of you today. Have a good day, everyone. Take care.
Thank you, Guy.